Welcome to Financial Detox. We're your hosts, Jason and Alex from IDA Wealth. Your financial journey of pursuing better and true financial peace of mind starts here. Hello, welcome to Financial Detox. I'm Jason Labrum, your host in studio with my man,
Alex Klingensmith.
I'm excited to be here, Alex. This is a great show. We are talking about today the retirement risks nobody talks about. And they are substantial and they could derail your retirement in a bad way. What do you say about this show, Alex?
I like the other show title that I was saying earlier, that the market doesn't care when you retire. And that's really what this has to do with. That you could have the best possible plan, best strategy, but if you don't know how to navigate volatility when it does come, especially if you're within this red zone of retirement, it can really mess up your plan.
For 28 years, we have been helping people. That's myself. Alex is not many behind me. We have been helping people design and build investment strategies to help them enjoy what life has to offer. We are really big in investing well and living fully. Too many people invest and then they stress, and we do not allow it. Our clients are forbidden from investing and stressing. Instead, we invest and set them free to live a life of true financial peace of mind and abundance. And it's really important that I think you understand the things we're going to talk about in today's show so that you know you've done what you're supposed to do to make sure that there isn't hidden risks or the market. You don't care that the market doesn't care about when you retire, as to Alex's other examples. So let's dive into heavy visuals in these. Bear with us. We're going to walk through the visual and kind of talk you through it as we go. So the first one we're looking at is where, Alex, why don't you hit kind of the outline there?
Yeah, so it's the same average return, two very different outcomes. And this would be a retiree, two retirees, it says. They have the same $1 million balance. They're each taking the same amount of money on an annual basis, so $50,000 a year. They're each earning an average annual return of 6%.
Yep.
But the difference is staggering when their losses hit, meaning when the markets are moving based on when they retired. So you got retiree A in years 1 and 2, they're down 15% each year. In years 3 through 18, there's a positive 6 per year. Versus B, the losses hit later. Right. So years 1 through 9, they had their target rate of return accomplished, solved for 6%. But at the very end, years 10 and 11 down 15 each year.
This is what we call sequence of returns. And Alex, I think you got to talk louder and get excited about this because I'm not sure that our listeners can hear you. And this is exciting because we're talking about saving you from making catastrophic financial mistakes. So this is called sequence of returns. If you look at it from the financial ease that we all speak in this industry, when do you get the returns that you get will have a dramatic impact. And as you see through other parts of this video, we'll give you more information about kind of how that works and how that is delivered. I saw a presentation the other day, Alex, and we could literally do shows on just other people's financial advice that is really bad. And a guy was talking about the sequence of returns and the 4% rule. They've changed it to the 4% rule from the 5% rule, particularly insurance companies and annuity companies, because they want to give you back less of your money so they can keep it longer and continue to get more fees on it. And they're actually just promising that you're only going to get your own money back. And the guy was talking about the 4% rate of return. And if you have any advisors telling you that the 4% rule or 4% is a realistic rate of return, I think they're selling you probably a lot of fear, and you should consider redesigning your portfolio. However, what is the number? Is it 5? Is it 6? Is it 7? It depends on you. And it depends on how your portfolio is constructed and how much income you want to take and what your desires and goals are at the end of analysis, AKA death. Do you want to pass money on to your heirs? Do you want the last check to the mortuary to bounce? What is your plan?
All right, you got me excited. So check this out. Look at the screen. You just gave me a really good talking point. So if $50,000 a year out of $1 million is 5% and you're averaging 6% a year, one way to look at this is, well, I'm positive 1 every year, so I'm good. right?
Yep.
And I think I've actually said those words out loud and been wrong. So let me correct myself on the sequence of returns here. If you look below, retiree A runs out of money in year 15, right?
Yep.
Literally gone. So the 18-year time period horizon was not accomplished. They ran out of money. Hopefully they had other accounts or other assets beyond this $1 million because that plan does not work. Now, retiree B with sort of better luck in the sequence of returns, when the losses hit later, a lot later, they still have plenty of money left over in year 18, 750,000 of the million, right? Same average annual return, but the sequence of returns really, really affected the outcomes here.
So, I mean, this would be an argument for somebody trying to sell an annuity is that like, hey, guarantee your rates of returns. You can never run out of money. I think there's other ways to also do it, and none are wrong. Sorry for the stuttering there. There is no wrong answer. There is no one answer fits all. It really depends about you as a person. And if your financial advisory team is not taking the time to get to know you and what you are trying to accomplish and how you feel about volatility, then you're not with the right team. You really want to understand the whole situation. Now, Alex, let's also talk about this since we're on part one here, the retirement risk nobody talks about, or the market doesn't care when you retire. When we talk about this, if we had retiree A as a client of IDA Wealth, a financially detoxified client,
good client.
What would have happened to that client and their financial plan? Would we not have already projected or ran analysis with the assumed potential volatility that just happened to come at the wrong time?
I love it. You're taking us right to the conclusion how we solve for these problems, right? Yeah, a client-advisor relationship is a living, breathing, dynamic thing whereby there should be regular communication, especially when major market events take place, especially when somebody is just retired or nearing retirement. Or soon after retirement. And that's when the financial plan and the stress testing of the Monte Carlo comes into play. We'd be able to see this problem coming way before it presents itself. That is the point of what we do.
Yep. So also too, when you look at these numbers statistically, you need to look at details about, is the 6% of return gross of taxes or after taxes? How tax efficient are you? Where is the money coming from? An IRA account? If it's all coming from an IRA account that is still taxable, that's a show we did a while back called the Retirement Tax Trap, where people put a bunch of money in defined benefit plans or retirement accounts. They get to retirement, they're still in a high tax bracket because everything is still taxable. So a lot of different factors here. I think you really need to unpack this. And if you're not using a cash flow based, comprehensive, interactive, and integrated financial planning system, you're going to probably run these numbers and they're going to be wrong. But you can know the answers. You can stress test ahead of time what is all the potential volatility that has ever been experienced in the market. What is that going to deliver to me if a worst case outcome happens and the worst time happens?
Absolutely.
And by the way, investing is not supposed to be easy and fun. Investing is actually hard work, requires a lot of discipline, patience, and planning. And it's not that fun sometimes. Sometimes it's fun. A lot of times it's not.
Yeah. Lately it's been fun.
It has been. Talk to us about the big picture here, Alex. What do we got going on?
This is a huge one. There's so much to this one. I mean, it says the rules change the moment you stop working, right on the screen there, right?
Yeah.
And I think the rules change in lots of different ways. What we're talking about specific to this show is if you've got a risk when you retire that you're no longer accumulating money, meaning you're no longer working and earning and saving and then investing that money anymore. Now you've switched gears. Like you don't have any more paychecks coming in. Like you'll have Social Security, hopefully. You might have a pension if you're lucky. But by and large, you're going to be relying upon your savings, your portfolio savings through your retirement accounts and non-retirement accounts. And now you're in the distribution phase, which is the rules have changed because when the sequence of returns presents itself, meaning that a down market comes, you can't do what you used to be able to do while you were in the accumulation phase because you're no longer earning that money, right?
Unbelievable. Yeah, it's such a good point. There's so many visuals on this. So we understand the brain damage of trying to read through all of these words, but we thought it was just important that you see it all. And so as we're talking through this. You can also read about it. But what I really like here, Alex, is how we have this market scenario drops 20%, right? And if you're investing and you're still part of your company's 401k plan, or you're still running your business, market goes down, you just invest more. It's a phenomenal opportunity to dollar cost average down and buy more shares. The problem is when you're in a distribution phase and you're done working and the market goes down, if your portfolio goes down with that, which you get to control, right? The amount of volatility that you accept as you build your portfolio, hopefully tied to your interactive and integrated financial plan. But that's permanent impairment, as you see there on the slide, right? This is, you have to now probably sell shares down low if you haven't planned properly for your liquidity bucket and where you're going to get your income from. And even when the market drops and then recovers, do you recover? Maybe, but we address ways that you can counteract this, I think, and make it less scary. Correct, Alex?
Yeah. And I think the very bottom there, it says staying the course requires a system and not willpower. That's huge. I think a lot of really smart people that are disciplined understand stay the course. It's like a very, very Warren Buffett thing to say, buy and hold, be patient. However, when you're retired and if you just stay the course without making any changes at all, hoping it's going to come back and it's going to save you, you saw where, retiree A actually wasn't going to survive. Their portfolio wasn't going to survive, at least if they just stayed the course without taking any sort of action, which would come from a really good client advisor relationship where you have this financial planning experience where you can see where you need to course correct. But on the back end, a professional investment management team like we have here we'll actually do a lot of things on the back end to navigate that volatility and put people in the best possible positions to recover and maybe even do better than just recover while still retired.
So good. All right. So we got a 10-year danger zone. This is heavy on visuals. We understand lots of font, lots of numbers, lots of words here. So bear with us as we'll kind of walk you through this. Heavy on visuals. We're happy to send you this slide if you would like to, or these slides for each of the parts if you want to see them individually and just have them to look over. The best way to get a hold of us is just to send an email to jason@financialdetox.com. We check that email every single day and we will get back to you right away with any information that you need. And also if you want to have some help unpacking the retirement risks as you get ready to retirement, then we're here to help you do that and make a serious impact on your wealth, give you true financial peace of mind. So the 10-year danger zone, Alex, hit it.
Yeah. So you can see there in the accumulation zone, you're quote unquote safe because you're earning, you're saving, you're investing, you're building up the different types of account types, pre-tax, after tax, tax-free. And then you flip to the danger zone, which is like the 5 years leading up to your retirement, which is very personal. We all retire at different moments for different reasons. Some of us are blessed to retire younger because maybe we cared about that, thought about that. Maybe some of us were waiting till 65 or maybe it's 70, all the way up to 70. That's generally the danger zone for most of society here. And that's really the most dangerous part because as you can see that's where you're at your peak, right? That's when your accounts are going to be at their largest value in theory. Although I would like to challenge that theory right now, because if you do a really good job and you have a proactive financial planning team, you can actually maybe think about the next generation or the generation beyond that. You can build your financial plan so it's not at its peak during that danger zone. You can continue, you can go to and through that and where you leave behind, way more than you retired with. That's a choice you make as well along the journey, depending on how you invest and how you spend. And then distribution, it talks about really just that the sequence risk diminishes because you have less time, which is kind of a morbid thought, really. And also you're in theory, you don't have as much money then because you are diminishing the base.
Yeah, and Alex, I think there's a lot of misnomers out there for people who are retiring. The 4% rule, the 5% rule, it may be the 7% for you. It may be the 2%, who knows? It really depends on your situation. So I don't like the rules. I don't like the rule default that you take your age, divide it by 100, and that's how much equity allocation you should have. And you automatically should be getting more conservative as you get older. Maybe not. What you should be doing is just making sure that your plan, stress tested, probability analysis run on your plan, tells you that you have a high probability of success, somewhere 70%, maybe 80 or 90. once you get over 90, it's probably too high of success, because then you're going to have a lot of money left over unless that's your plan. But I don't like those rules, Alex, because they force people into boxes, and we are not all the same. Everybody is different. Their attitudes about money, their psychology around money, volatility and risk, it's all different. And so this becomes so personal and intimate that you really need to unpack this with your own selfish mindset, right? What about me? What do I want to do with my money? What is the purpose of my money? What type of volatility am I comfortable with, so that I don't panic and change? And then also, we're going to show you ways where certain types of rebalancing can automatically alleviate a lot of these risks and volatility. We do our rebalancing primarily to reduce volatility, not to enhance returns. And a lot of people think it's the opposite. I'm rebalancing to enhance returns. Not really, but by reducing volatility, we in turn end up providing better long-term returns, because the lower volatile portfolios still end up working better over longer periods of time in most cases. So this one's pretty sweet, simple and easy. Lots of words on here. There is that danger zone. You need to be aware of it. You need to plan for it. If you don't, you could make some catastrophic mistakes. Man, people have been lucky over the last 10 or 15 years, haven't they, Alex? There's been very short downturns. They have been insignificant from a time standpoint. Nothing like 2009 ended up good, but it started bad. But 2008, 2001, 2, those were some really tough extended periods, and people have not had to experience that.
Yeah, I like what you said about psychology of money. It reminded me of the book by Morgan Housel, actually. I mean, if you look at the bottom statistics there, I know these are huge groups of people being sampled and surveyed, so you got to find yourself within the numbers and the statistics. But I mean, 3/4 of people, their outcome is going to be determined by the first 10 years of returns, right?
Yeah.
And then you got the 4.2 million. This is interesting because psychology of money talks about how there's a generational, depending on which generation you're in and how old you were, it shapes how you feel about money. So we have some clients who've retired and they're frugal. They're like fearful of spending, right?
Yep.
So their financial plans are probably going to be successful if those habits remain. Other people, they retire and they're like, I have all this extra time on my hands. I can't wait to go do all the things. And they start spending a bunch of money. And so you can imagine what will happen then if the sequence of returns hits those people at the good time versus the bad time. And that's where having an accountability partner in this retirement journey, AKA a great advisor team, a fiduciary advisor team, can help you stay accountable to your plan, which then is, it's like the best thing. It's like when you have a personal coach for training and you think you're doing a good job with your diet and exercise. And the coach is like, yeah, you're actually slower than you were last month and your BMI has gone the wrong direction. You're like, oh, yeah, you need to hear that stuff. Though. You need to hear that stuff.
Yeah. We're not trying to run scare tactics, because we don't do that. And then ultimately just sell you annuities that provide you with low returns and guaranteed income for life, quote unquote, guaranteed your own money back. And those may be right for you in certain situations, by the way. But what we are here to talk about is how we are handling some of these serious issues, like the 10-year trap or the 10-year risk and the early sequence of returns and different things we talked about. So why don't you lay out what we're going to be talking about over the next couple minutes?
Yeah. Again, lots of words on the screen here, some colors, some pictures, but the concept we're trying to show you here is that if you break down what we can control into two key principles here, how you manage your money, when you make decisions through when volatility is happening, a little bit of volatility or a lot of volatility, it doesn't really matter as long as there is a system to follow, an objective system rather than fear-based or emotion-based or even greed-based, which can be even more dangerous than fear-based, right? Chasing after something that you think is going to go up. So what you see in principle one, this is one of Jason's favorite things to talk about. If you ever run into him out in the wild, just ask him about tolerance band rebalancing, and you're going to get really good excited version of Jason.
I'm getting better though. I'm recovering from my
you don't fight
incessant behavior around tolerance band rebalancing.
He'll just give you a big hug, I think. But it's a really cool concept though, and what it does is it forces you to always sell high and buy low. I know. Without knowing what's going to happen next, which is really nice, because without knowing what's going to happen next means that there's peace of mind around the decision making of when to trim back a position or an asset class, right? US equities is the first one on the screen here. based on its historic standard deviation, which is that weird little O thing with a line over it, right? And so
Yep.
there's some standard deviation, some volatility expected in every asset class, right? Some have more than others. So why then would you do it automatically once a year or once a quarter at the same degree, to, irrelevant of the asset class? That doesn't make a lot of sense. There is a better way, right?
There's so many bad strategies. And this is why the book Financial Detox was written, and why we call our show Financial Detox, because we really want to help you avoid toxic advice. Most toxic advice comes in the form of generalities. The saying something in a statement about an investment strategy or a type of investing, the 4% rule, 5% rule, whatever it may be, you must get more conservative as you get older. Not saying those are wrong, but they're really, in general, it doesn't necessarily apply to you personally and individually. And same with rebalancing strategies. There's some of the main rebalancing strategies are really flawed. They would rebalance an entire portfolio because one asset class or one sleeve of the portfolio is 5% off of its target. That's just crazy. You create all kinds of tax gains unnecessarily, and you actually chop the legs off of sectors or sections or asset classes of the portfolio that maybe are just beginning to run. So what we built is this, what Alex talked about here is how do we rebalance a portfolio, but do it very intelligently, unemotionally, systematized. And so as you can see there in the middle of the page, like when the market falls, we're kind of forced to buy, automatically buying. When the market rises beyond a certain point, that would be the disclaimer there, then we're automatically trimming profits. And we're always taking our withdrawals from something that's up. So if you're in that income phase of retirement, especially those really scary years, those first 10 years where you don't want to have a really negative sequence of return, the way you take money out of your portfolio matters. It may be the difference between whether you run out of money or you don't, or whether your plan is really successful and not.
I like Principle too. You taught me this one a long time ago. When I say a long time ago, for me, it was like almost 15 years ago. So it's been a little while, but it had to do with the fact that there's a total return approach to investing, meaning don't just chase dividends or yield and bonds or things that are going to appreciate really quickly. Think holistically across your entire portfolio of different account types, meaning that there's pre-tax, there's tax-free, there's after-tax account types. And if you put all that together into a unified portfolio, be thoughtful about, you want growth and income, you can solve that in a much more, I'll use the word elegant, but also it's disciplined, than like the bucket strategy, which is another, if you like were to go on AI or Google, like, how do I do this total return? Buckets would come up. It's pretty common. It's a good, it's a good sales strategy again for insurance companies, almost always, to get the annuity in there somehow. We're not talking about that. We're actually talking about a much more sophisticated way to take all aspects of investments, including private alternative investments, which is we didn't touch on that yet on Principle 1, and put it into just a unified way to approach things so that you do solve for market volatility, you do solve for taxes with what within control, right?
Yeah, things you can control, things that matter. We talked about some of the things that are risks that people maybe aren't talking about. We're talking about why the market doesn't care about you and when you retire. But now we're bringing you some solutions as to how you can intelligently work with that. And rebalancing a portfolio and how you rebalance it, how you tax loss harvest, all these things will have pretty big impacts and outcome differentiators in your portfolio. You talk about the total return strategy there in Principle 2, Alex, but there's the total return, like from a generation of returns, but then there's also a total return income strategy, right? Like, where am I going to get my income from? And simply stated, stocks pay dividends and bonds pay interest. And you also have capital gains or rebalancing, trimmings that can all derive your income. So a lot of people think I need income, so I've got to build a portfolio that's paying me my 4 or 5 or 6% income. But you don't, because your income can come from multiple sources. It's called total return income planning or total income planning, where you're looking at the different sources of income, where they come, when they come, and using that to derive the withdrawals that you're taking from your portfolio. Lots of information there. We encourage you to always reach out. Let us help you. If you want some guidance on this, we can make a financial plan for you that is interactive and integrated and cash flow based, that takes into account all these components. If you're getting ready to retire or you've just retired, this is time to get second opinions and make sure that what you're doing is right. Why does it matter right now?
Why this matters right now? Well, the markets have been phenomenal this past 3 years. Stock markets, bond markets, private alternative markets, almost every market's gone up the past 3 years in a row. Except for recently, literally in the past, like year to date. It shows you the S&P, which is not the market, but it's a good indicator. It's 500 of the largest companies in the world. So that's not a small amount of markets, but it's not the private markets. It's not bonds. Either way, it is setting a stage though for why it should matter. If you've experienced all this upward drift and you're thinking, oh, it's a perfect time to retire, like sequence of returns, I'm nailing it. Actually, it's the opposite, because if it does move the other direction now for a couple of years and you start off, like Jason said, as it was retiree A. Yep. And that bad luck happens to you right when you're out the gate of retirement. Not only will it affect your portfolio and your long-term outcome if left unchecked, it probably will affect your mood, right? You just retired and you're like, oh, that's kind of scary and depressing, right? So
well, it is scary, Alex. I mean, you and I are not retiring yet, but if you think about for the most of Americans, right? You work your whole life, you get ready to retire, and then you're hearing about the markets. You kind of understand them, maybe a little bit, maybe you don't. Education around finance and investing in our country is pretty dismal, pretty bad. This makes me think of a client conversation where we were talking about alternative investments and the benefits of diversification and real diversification. Everybody knows about buying stocks and buying bonds, right? I mean, that's general, straight down the fairway, publicly traded stuff. But to get deeper into the diversification topic and you start talking about alternatives and different investments that can and have historically lowered your volatility by pretty substantial margins, those become important. But this particular client I was talking to said to me, I don't buy it. Not interested. The S&P 500 did 30% last year. I said, okay, that's great. What does that mean for next year and the next year? And tell me about the S&P 500 from 2000 to 2009, a 10-year period. What was the total rate of return? Do you remember, Alex, that 10-year period?
It was down 9%. Not an average annual return of 9 per year, -9, but you're down 9% in 10 years. Is that right?
Over 10 years. Your money was invested, and 10 years later, you had a negative total return of 9%. And if you were taking out 4 or 5% withdrawal during that, let's just call it 5% during that 10-year period, you took out 50%, you lost another 10, you're down 60%. This is very scary. So it matters that you don't make your predictions or build your investment plan based upon what's happened the last year, but certainly not the last year, but not even the last 5, 6, 7 years, because trends happen. Markets get really good they've been good for 10 years, 15 years. We've had an unbelievable run. And we believe in markets, right? They're going to work over the long term and you're rewarded as an investor, but there can be some really difficult times during that. So you want to make sure that you're planning around that. And we at IDA Wealth and the Financial Detox team have been long time students of alternative markets and investors in alternative markets. And we think that the time to invest in alternative markets is probably more compelling now than it's ever been, given how strong public markets have been, stocks and bonds, and the opportunities that exist with companies staying private longer. They're just not IPOing like they used to, because when a company IPOs, it's doing that to gain capital, to get capital, to have a capital injection. And most companies don't need to go public to get capital. They can go to private equity. And then the next round of private equity is the next capital event, and then the next round of private equity. So we've had a pretty serious decline in publicly traded companies that are available to invest in, while we've had a continued increase in private companies that are available to invest in. That's private equity versus public equity. And the same thing has really happened due to regulatory environments and different things with private debt or bonds. So a bond is when you lend money to somebody with a promise to get your principal back and interest along the way. That happens not only in public markets, but it also happens significantly more in private markets where you're private loans. So what we're talking about today to wrap up this series is how adding alternatives can shift the efficient frontier. It can reduce the volatility, which takes away, where we talked about the sequence of returns. Well, it doesn't take it away, but it can reduce the negative consequences of sequence of returns, getting bad returns early in retirement. We've got the rules changing and how you withdraw money from what account types and all that type of risk involved in retirement. And then we had the danger zone where we talked about that 10-year period right before retirement, right into retirement, where if you get a negative sequence of returns, then we went on to start talking about how you can solve for these in a more intelligent, thoughtful way, including precision rebalancing, having a financial plan, cash flow analysis, stress testing, building more diversification into your portfolio. And we're touching on the final component here is alternatives. Alex, why don't you give us the overview here? I'll summarize it and wrap it up. And I think we got a couple visuals here. Not as much information as the previous visuals, so a little easier on your eyes. But why don't you introduce this, Alex, and maybe set the stage for where we'll go with this.
Yeah, I think the whole goal here is to try and give you a better outcome, right? So if I can have the same return with less volatility, that's what I want, right? As an investor, why not? Why would I want more volatility in the same return? No. So what the numbers on the page show, and all these colors and the green and the blue line is really kind of just summarized there in the middle, that if I can have 7.8% volatility versus 9.5% volatility, traditional only is the 9.5, and then if I add 25% of private alternatives into my portfolio, I can reduce the volatility and accomplish the same return. And by the way, there's lots of disclosures and disclaimers around what we're talking about here, which private alternatives is important, which managers is really important. And obviously these things will change over time. So past performance is not a guarantee for future returns or future outcomes, but the concept is really important though. And Jason, you talked about the reason why, like why are private alternatives able to accomplish this? We should probably talk about that a little bit more. But just for a moment, assume that that's correct. And we all know this basically in its purest form. You've got stocks and bonds in the public markets. Why do stocks generally perform better than bonds, right? Because there's just more inherent maybe risk or volatility, different kinds of stocks more than others as well.
Yep.
Versus bonds just by nature have less volatility, therefore there's less return. So how are alternatives able to give me more return for less volatility? And then how do I implement that in my portfolio?
Yeah, and I don't think they always do, right? I don't think you can ever say that conclusively, if I own alternatives, I'm going to have more return. You may have the same return with less volatility. You may have less return, depending on the alternative that you selected. So manager selection is really important there. But generally, when you look at public markets, they're efficient. A public market is pretty efficient in that if we're buying Apple, most people know everything there is to publicly know what's available about Apple. I mean, we know what the earnings are. We know who the CEO is. We know what the cash flow is. We know all the things because they're a public company and they have to have public filings to tell everybody what's going on. And that information is exchanged almost instantaneously around the globe. But when you think about private companies and private debt and private credit where you're lending money to people, that's a quite inefficient market. I mean, who do you know? Like if you look at IDA as an example, and it's not an investable company to the general public, but you don't know a private company's financials. You don't know what their growth rate is. You don't know how they sit compared to their competition unless you're out doing that due diligence, research, and work. That's why I think there's more opportunity in private companies. Oftentimes they're smaller and more growth oriented. But that's also why there may be more risk too, where if you go and pick bad companies that are mismanaged, you don't have the protections that public markets can provide for you with disclosures and filings and such. So it can be a double-edged sword, and it needs to be done correctly. But if done correctly, and you look at the history of endowments and institutions, super ultra high net worth and sovereign wealth funds and family offices, they've added quite a bit more percentage allocation to alternatives. And in most cases, those results have been better. They've been better because they're doing it intelligently and they're getting the results from that. So the second visual that we have here, the first one you see is where we've taken all the portfolios along an efficient frontier, and we've added 25% allocation to alternatives. And across the board, historically speaking, that has shifted the efficient frontier to a higher returning, lower volatility, or some cases just a lower volatility position, which is great, right? If I can go get the same 9.5% return, but have a more peaceful journey, then that's good. And it closes the window for behavioral mistakes because of volatility. So I think that's one. Alex, as we go down and look at the second slide, it's kind of the same concept. What we're looking at is the first two major asset classes everybody knows about is equities and fixed income. That's stocks and bonds, right? And publicly traded, you have a measure of volatility associated with those, and you have a measure of return, historically speaking. And then when you go down into the private or alternative space, you have the same measures and they're just different. Part of it may be masked, right? A private company doesn't have a value that's posted every single day. And public companies, they're subject to the emotions of the market and the pendulum of buyers and sellers and institutional traders that could be moving and creating more volatility unjustifiably. I would say that publicly traded stocks, their volatility doesn't change as much as the markets would lead you to believe they change, because they're pricing new information and there's also emotions attached to that, and people being able to trade trade the stock every day. In a private company, you can't trade it every single day. So there's more, I would say, protections around the volatility that can sometimes come with public markets.
Yeah. This is a good one to focus on right now too, just given the timing of all the press around private credit. And I think we talk about it from both sides. We want to debate both sides of every investment that we
Yes.
Do due diligence on for our clients, because we care about the client outcome more than anything else, right? Yeah. And so this asset class has been around for not that long, 10 to 15 years, reliable sort of source data that we have in front of us here. Why is it done? It's too good to be true. If you look at this thing, right? You're like, wait a minute, I'm getting stock-like returns with bond-like volatility, kind of like to the whole point of private alts. What's the catch? And the catch is always going to be in stuff like this, that the manager is doing the right job. The manager is taking the appropriate amount of risk. Also, just like any other asset class within a well-diversified portfolio, it will have its time to succeed. It will also have its time to be the worst asset class of the moment. It doesn't mean that it's never going to come back, though. And that's why diversification, and back to sort of the crux of this series that we did, is it's a really important time with three plus years of really positive asset performance, investment performance, to take a look at your portfolio, take a look at your financial plan, and make sure you have an even better way to navigate the volatility that is to come whenever it presents itself, however it presents itself.
And Alex, we can help our investors. If you're a Financial Detox listener to the show, then you know that we offer kind of a retirement readiness review, and we are doing that today. Look, we help people make better investment decisions, and our firm is built around creating an environment so that you can invest well and live fully. You get the best out of your life. This is not about collecting a bunch of money that we can manage and you live very stressed and tight. We want to set you free. And for some people, they want to pass money on to their heirs. For others, they want to spend it and live a life, but they're scared to do that because they don't know what they can do. They don't know what their true financial potential is. And so we would encourage you to live your full financial potential. You can do that with the Financial Detox and IDA Wealth team. You can do that with the retirement readiness review that we have. So simply send an email, jason@financialdetox.com. You can look us up at idawealth.com, and you can get in touch with us very easily. We'll take you through this whole process and make sure that you're protected. We hope you got through it all. And if you would like the visuals, again, contact us and send a request. We can send you the visuals so you can digest those at your own pace. We invite you to reach out. It's a great time to make sure you are on track doing the right thing with your portfolio and your financial plan. That's all I have for today. You have anything else, Alex?
Nope, that's a wrap.
That's a wrap. Thanks for tuning in to Financial Detox. I'm Jason Labrum with Alex Klingensmith, and we hope to see you soon on the next show. Have a good one. Bye-bye.